All right, welcome to Lesson 8, Intro to Market Structure. This is something that's very, very important, and it's going to be one of your key confirmations in determining a trade that you want to take. And a lot of people overlook this, or they trade against the overall trend. So if trend is bullish, meaning it's going up, and they decide to take a sell, a lot of people, what tends to happen is if they have high, low, a high, and price starts making lower highs and lower lows like this, this might be the 1 hour low and the 1 hour high, and this might be the 5-minute counter trend coming back into this low here. And then when it comes back into this low and it comes up, people sell here thinking price is bearish, but it was all just counter trend to get back to the old low to then continue upwards. Okay, so this is why market structure is really, really important. Now, something to keep in mind is something you should write down in your notes. Hopefully you've been taking notes the whole time. If you haven't, go back, watch all the videos and take notes on them, because you will need them and you will refer to them. I still refer to my notes to this day. To this day, notes from a year ago about, oh, what was that thing? I forgot it. What is it? Oh, I have a note on it. And I'll go through my notes. Boom, there it is. And I found it. So something to keep in mind is the higher time frame structure is more important than the lower time frame structure. So what I mean by that is, if on the, let's say, the 4 hour price is bullish, price is going like this, but then on the 15-minute price is going like this, this is still a bullish structure. It's still a bullish trend, because the higher time frame, 4 hour low, 4 hour high, this is still bullish unless this low is broken. If that low is not broken, then this is still bullish, and this is all just a counter trend to come back to this low here. Okay, but let's go back, start at the basics. So in a bullish structure, if you have a low and we have a higher high, let's put this right here. You have a higher high, and then this is your low. You want to see a higher low formed right here, and then you want to see a higher high. Now what comes after a higher high is a higher low. So then you would anticipate price to come down and make a higher low, and then a higher high. So in a bullish structure, you want to see higher highs and higher lows formed. Now, vice versa, if you have a bearish structure, you have a low. So this is our high, this is our low. You want to see a lower high created, and you want to see this old high respected. Then you want to see a lower low. And then after a lower low comes a lower high, and then a lower low. Lower high and lower low, continuously in a bearish structure. This would be your lower low. Right here is your lower high. So lower lows and lower highs formed all the way down. Now, at what point does structure break? Because structure breaks, it reverses, and recognizing a breakup structure is very, very key, because you can catch a lot of good entries on breaks of structure. So if this is the 4-hour range, what you want to do is identify your trading range. So from here to here, this high to this low is the trading range, and then a lower high is created, and then price makes a lower low. So now the trading range is here to here. So if you're bearish, you want to see this old high respected, and you want to see this low broken. So now our trading range is from here to here. Then we have a low, we have a lower high, and then let's say we have another lower low. So that's your trading range. So to identify a breakup structure, what you want to look for is you want to look for your trading range that you've identified to have a candle closure above the trading range. So if price comes up, comes through this high that you've identified as your trading range and closes above it, meaning not wicks, because wicks are not candle structure. Market structure is built on candle bodies only. So a wick is not a high or a low in market structure. So if you turn the line chart on, you'll see where the candle bodies are. So although price may look like a breakup structure because it wicked above an old high, let's say this only wicked up here, this would not have been an actual break, if we're on the 4-hour for example, unless the candle closed above this high. And then that would be your breakup structure. So since you've identified that this trading range right here had a candle closure above it, your structure is now broken. That's your breakup structure. So now that we broke this high, this low to this high becomes our trading range. From here to here. So you would look for, after a higher high, you look for a higher low, because now the structure is switched to bullish. And then you look for a higher high, and then a higher low, and then a higher high. Now if this structure were to break again, the way it would break is you identify your trading range. So if this is your trading range, okay, from here to here, you are bullish on this until this trading range is broken. So if price comes down and closes below this low, that is a break of structure. So now what are you looking for? Now it's switched to a bearish structure. So on a bearish structure, we have our high, we have our low, we look for a lower high. Then a lower low, lower high, and a lower low. Now what many people get confused with is, like I mentioned, they get caught in the counter trends. So if this is, let's consider it our 4-hour structure. So 4-hour structure. Let's say we have a counter trend, which is a trend that goes counter to the overall direction. So if the 4-hour structure is bullish, any smaller time frames, the 1 hour, the 15-minute, the 5-minute, On its way back down to this low, which we identified as our trading range, from this low to this high, it's going to walk down, make lower highs and lower lows. Now we're overall still bullish because our 4-hour range, which is a higher time frame, is bullish. So the higher time frame structure is much more significant than the lower time frame structure, because within this higher time frame you can have lower highs and lower lows, and you can see price come back into this lower low over here, just to then break structure to the upside on the smaller time frame. Let's say it's a 15-minute. So this would be your breakup structure right here, a candle closure above this high on the 15-minute, but your 4-hour low was respected. So if we broke structure on the 15-minute here after we come into this old low, we would anticipate price to come back down to where the structure was broken and then give us a higher high, and then a higher low and a higher high, and so on and so forth until we close above this high and we make a new higher high on the 4-hour. Now again, this can be 15-minute higher highs and higher lows until we get above this high, but our 4-hour trading range, this low was respected, so this was still bullish. So yes, the 15-minute may be bearish inside of here, however the overall direction is still bullish. So let's say now we have our high, and this is our old low over here. Price is again in a counter trend, comes into the old low. What you want to look for is your breakup structure to the upside. Right there, there's your breakup structure. Come back to where the structure was broken, and then price expands again, creating a new high. Now this is important on all time frames. Okay, 1-minute breakup structures are personally what I like to trade. So I will have a 1-hour structure. Okay, for example, I'll have a 1-hour low over here, like that. But now, as price is coming down here, and it gets into my point of interest, this institutional candle, which is the last down candle before the up move, this 1-hour low, I'm looking for a breakup structure on the 1-minute. Oh, when it comes into my point of interest, break structure, I can get in on a pullback here. So let's say we have a high here, low. This was a candle closure above this high, so that would be your breakup structure. You can enter here. Now it makes a higher high, higher low. You can have another entry here. It's a high, it's a higher low. You can enter again here, and you're still bullish. Now, if that structure, this range, high, low, high, low, high, comes into a counter trend, doesn't break structure and just continues lower, and gives us a candle closure below this low, because that's our trading range, that would be your breakup structure. And then you'll be looking at this high here, and the low that's created here as your trading range. Once you've identified your higher time frame trading range, you will then look for price to pull back up into your institutional candle that will be sitting in this area. Look for that breakup structure in that area. So that would be your breakup structure right there. a close below this low here. And your entry will be right here. And you take it all the way down to a lower low. Now don't get lost in the smaller time frames. You want to pay attention to the higher time frame directional bias. So if the daily candles are looking bullish and the 4 hour is bearish, you're looking for the 4 hour to come into a daily point of interest to then break structure to the upside, and you're looking to take a buy. Now if it comes into that daily low and it doesn't break structure and continues down and ends up closing below the daily range, that would be your break of structure. Okay, so let's go into some examples here on the charts. I'll show you exactly what I mean. So this is the 1 hour chart. What we're going to identify is the trading ranges. Okay, so here's a low. Here's a high. We're looking for a higher low. Now you'll notice, see how this down candle right here wicks below this low and this low, however closes above the 1 hour range. That is not a break of structure. That is a bank manipulation to drive price lower to then take out this low. So we have our low, we have our high. This would be our higher low. And right here will be our higher high. Now you'll see price then. We have a high. This is all counter trend. See how this is bearish counter trend, but we're still bullish on the 1 hour. Price comes in, fills in an imbalance right here, as we can see, runs away to the upside, and then we had some news. This is around 9 o'clock candle. It was likely it was the 8:30 news, so very possibly NFP. You see a wick all the way down below this low. Just like last time, how we mentioned mitigation theory. The sell that the bank put in to run these lows, when it comes back into there, they're mitigating that and closing it. And then they're adding long positions as well. So you can see, we have a low, we have our high. This candle closure is our higher low. And then we get our higher high. Higher low. Higher high. Now you can see right here, this closed below this low just by the tiniest bit. However, this was our range. So we didn't see any break of structure to the downside, so we're still bullish. So then we have our higher low, higher high. Higher low. Now right here, is this a higher high? No, it's not. So this doesn't count for a higher high. So if we have a high, we have our low, and then this respects this high, this is our low, this is still our high, this is our higher high, this is our low, we're looking for a higher high. So if this makes a low in here and breaks below this low, we're still looking for buys, take price above here. Once we get a candle closure above, that is a new higher high up there. And then we're looking for a higher low again. So continuing on, we have our high, we have our low. This isn't the higher high. No, this is the next higher high, right here. And then we make a higher low. Zoom into this a bit. Then we have a higher high, our higher low. We have a higher high, higher low, higher high. Whoop, what happened here? Break of structure. This was our range that we identified, right? The candle bodies. We had a close below this 1 hour candle body range. So that's our break of structure right there. So if this is our low, this is our high, we break through this low, our trading range is now from this high to this low, and we're looking for a lower high to be made, like this. Price continues lower, makes a lower low. And since this, right here, will be our trading range from this high that we identified, and this is our low. We're looking for a lower high below this low because that's our trading range. So price comes up, respects this high, and then breaks down, and jolts around a little bit, then gives us run lower. As we can see, now we have lower high, lower low, lower high, lower low, and right here, if we were to continue, what we identified, let's tidy the chart up a little bit here. This high is our high, and then this low is our lower low. So your trading range is this high to this low. Let's move it to this low there. So this is our lower high, so we're looking for a lower low, which we get, and then a lower high in this area. Now this, since this is our trading range, you can see we have a candle close here. Price then makes a run up. However, we wicked above, you can see that we wicked above some highs over here, but we closed, the candle closed below. So that still respected the bearish structure overall. So if this is our high, this is our low, we're still looking to sell here. We then see a breakdown, pullback, and then a continuation lower, reaching for this low, and then this low over here as well. So identifying your trading range is very, very important, because what 90% of traders do is they don't have this high and this low as their trading range. They look at this. They'll see this choppiness here, and they'll see, oh, it had a break of structure to the upside. They'll look at this as a break of structure, and then when price comes down, they'll look to buy right here at their lower low, failing to realize that we have all of these equal lows, this liquidity, and we're still in a bearish structure overall. So price wicks down, runs the stops below these lows, makes a run up, comes above this high here, this double top, sweeps liquidity, closes below this high, and since you've identified this as your trading range, your high to your low, you're looking to sell this while everyone else is looking at, we have our high, and now we have another high. So then we're looking for a high. They're looking for a higher low out of this low, and then they got stopped out because they're trading a counter trend. Because the overall macro scale was it's still in a bearish structure. High, low, lower high, lower low. Okay, so that is the basics of market structure, and I will see you in lesson 9.